Assalamualaikum warahmatullahi wabarakatuh. My name is Nandila Feby Izami. I will present about basic financial statements. Now, let's begin the presentation. Financial statements are written records that convey the business activities and the financial performance of a company. There are four primary financial statements. They are balance sheet, income statement, statement of retained earnings, and statement of cash flows. Primary financial statements answer basic questions including what is the company's current financial status, what was the company's operating results for the period, and how did the company obtain and use cash during the period. Balance sheet is a summary of the financial position of a company at a particular date. A balance sheet provides detailed information about a company's assets, liabilities, and shareholders' equity. Assets are things that a company owns that have value. Assets include cash, accounts receivable, inventory, land, buildings, equipment, and intangible items. Assets are generally listed based on how quickly they will be converted into cash. Current assets are things a company expects to convert to cash within 1 year. A good example is inventory. Most companies expect to sell their inventory for cash within 1 year. Non-current assets are things a company doesn't expect to convert to cash within 1 year or that will take longer than 1 year to sell. Non-current assets include fixed assets. Fixed assets are those assets used to operate the business but that are not available for sale, such as trucks, office furniture, and other property. Liabilities are amounts of money that a company owes to others. Liabilities include accounts payable, notes payable, and mortgages payable. Liabilities are generally listed based on their due dates. Liabilities are said to be either current or long-term. Current liabilities are obligations a company expects to pay off within the year. Long-term liabilities are obligations due more than 1 year away. And then owner's equity is sometimes called capital or net worth. Owner's equity is net assets after all obligations have been satisfied. Owner's equity is the amount owners invested in the company's stock plus or minus the company's earnings or losses since inception. Sometimes companies distribute earnings instead of retaining them. These distributions are called dividends. A balance sheet shows a snapshot of a company's assets, liabilities, and shareholders' equity at the end of the reporting period. It doesn't show the flows into and out of the accounts during the period. Balance sheet answers questions including what are the resources of the company, what are the company's existing obligations, and what are the company's net assets. The accounting equation is assets equal liabilities plus owner's equity. The company's assets have to equal or balance the sum of its liabilities and owner's equity. Assets are resources to use to generate revenues. Liabilities and owner's equity are sources of funding. Liabilities is creditors' claims against resources and owner's equity is owner's claims against resources. Balance sheet limitations are assets recorded at historical value, only recognized assets that can be expressed in monetary terms, and owner's equity is usually less than the company's market value. Income statement shows the results of a company's operation over a period of time. Income statement answer questions including what goods were sold or services performed that provided revenue for the company. What costs were incurred in normal operations to generate these revenues, and what are the earnings or company profit? The formula of net income or net loss is revenues minus expenses. Revenues are assets, cash or account receivable created through business operations. Expenses are assets, cash or account payable consumed through business. Statement of retained earnings is an additional financial statement that identifies change in retained earnings from one accounting period to the next. The formula of any retained earnings is beginning retained earnings plus net income minus dividends paid. Net income results in increase in net assets, increase in retained earnings, and increase in owner's equity. Dividends result in decrease in net assets, decrease in retained earnings, and decrease in owner's equity. Statement of cash flows report the amount of cash collected and paid out by a company in operating, investing, and financing activities for a period of time. While an income statement can tell you whether a company made a profit, a cash flow statement can tell you whether the company generated cash. Statement of cash flows answer questions including how did the company receive cash and how did the company use its cash. Activities that result in cash inflows are sell goods or services, sell other assets or by borrowing, receive cash from investment by owners. And activities that result in cash outflows are pay operating expenses, expand operation, pay loans, and pay owners a return on investment. Generally, cash flow statements are divided into three main parts. Each part reviews the cash flow from one of three types of activities. There are operating activities, investing activities, and financing activities. Operating activities are transactions and events that enter into the determination of net income. Investing activities are transactions and events that involve the purchase and sale of securities, property, plant, equipment, and other assets not generally held for resale, and the making and collecting of loans. Financing activities are transactions and events whereby resources are obtained from or repaid to owners and creditors. Operating activities that result in cash inflows are sale of goods or services, sale of investment in trading securities, interest revenue, and dividend revenue. Operating activities that result in cash outflow are inventory payments, interest payments, wage, utilities, rent, and taxes. Investing activities that result in cash inflows are sale of plant assets, sale of securities other than trading securities, and collection of principal on loans. Investing activities that result in cash outflow are purchase of plant assets, purchase of securities, other than trading securities and making of loans to other entities. Financing activities that result in cash inflow are issuance of own stock and borrowing. Financing activities that result in cash outflow are dividend payments, repaying principal on borrowing, and treasury stock purchase. Notes to the financial statements disclose the detailed assumptions made by accountants when preparing a company's income statement, balance sheet, statement of change of financial position, or statement of retained earnings. The notes are essential to fully understanding these documents. Usually, the first notes in the series explain the basis for accounting, if cash or accrual rules were used to prepare the documents, and the methods used to report amortization or depreciation expenses. The rest of the notes explain in greater detail how the figures have been calculated. This gives the reader the information needed to do a deeper analysis. Fundamental concepts and assumptions are spirit entity concept, arm's length transaction, cost principle, monetary measurement concept, and going concern assumption. Spirit entity concept are the activities of an entity are to be separate from those of its individual owners. Entity is the organizational unit for which accounting records are maintained. An arm's length transaction refers to a business deal in which buyers and sellers act independently without one party influencing the other. All transactions are recorded at historical cost. Historical cost is assumed to represent the fair market value of the item at the date of the transaction because it reflects the actual use of resources by independent parties. Accountants measure only those economic activities that can be measured in monetary terms. Listed values may not be the same as actual market values because of inflation and measurement issues. Going concern assumption means that an entity will have a continuing existence for the foreseeable future. Financial statement analysis helps users make better decisions. Internal users of financial statement analysis are managers, officers, and internal auditors. External users of financial statement analysis are shareholders, lenders, and customers. Horizontal analysis is comparing a company's financial condition and performance across time. Vertical analysis is comparing a company's financial condition and performance to a base amount. The first example of financial statement analysis is debt ratio. Debt ratio is a measure of leverage. Debt ratio varies from industry to industry but should be around 50%. The formula of debt ratio is total liabilities divided by total assets. Next is current ratio. Current ratio is measure of liquidity. Current ratio is also called working capital ratio. Some successful companies have current ratios less than 1.0. The formula of current ratio is total current assets divided by total liabilities. Next is asset turnover. Asset turnover is measure of company efficiency. The higher the asset turnover ratio, the more efficient the company is using its asset to generate sales. The formula of asset turnover is sales divided by total assets. Next is return on sales. Return on sales is measure of the amount of profit earned per dollar of sales. Return on sales evaluated within the appropriate industry. The formula of return on sales is net income divided by sales. Next is return on equity. Return on equity is overall measure of performance profit earned per dollar of investment. Return on equity typically between 15% and 25%. The formula of return of equity is net income divided by owner's equity. I think that's all. Thank you for your attention. Sorry if any mistake. Wassalamualaikum warahmatullahi wabarakatuh.